Exploring the source of global excess liquidity in the past few years. The excess liquidity of global currency has mainly come from three aspects. One reason is that Japan's sustained ultra-low interest rate policy has caused international financial institutions and arbitrage funds to borrow heavily from Japan. Gold invests in various parts of the world. Japan's low interest rate policy can be traced back to the early 1990s 1991, 1993, 1996, and 2001. The Bank of Japan reduced the bank rate from above 6% to a rare 0.1% in stages. Under the guidance of traditional Western economic theory, the Japanese government has been adopting a policy of continuously lowering interest rates in an attempt to stimulate consumption and investment, and increase the speed of economic growth. However, not only did it not achieve the expected effect, but it also accelerated the growth of private savings. Not only has Japan's domestic consumption been sluggish for a long time, but its huge wealth and domestic capital have also been loaned abroad at lower costs. More seriously, when Japanese interest rates fell to extremely low levels, foreign financial institutions began to directly or indirectly borrow funds from the Japanese market and invest in Asia, Africa, South America, and even Europe. No one can calculate the scale of lending. Against the backdrop of continuously rising global price indices, once the Japanese government realizes its wrong monetary policy, gradually raising interest rates is only a matter of time. However, no one knows how much funds will flow back to Japan. Since 2006. The Bank of Japan has raised discount rates twice, which has proven to have a positive impact on the Japanese economy. The rate of appreciation of the Japanese yen since 2008 indicates that the current situation of Japanese funds flowing back from overseas is occurring. This increasing scale of capital outflow is bound to further the intensification of global currency and credit contraction has a negative impact on the United States' recovery from the crisis and the trend of global capital markets. Second, since the bursting of the foam in internet stocks, especially after September 11, the United States has rapidly and substantially reduced interest rates. And with the further expansion of the US dollar trade deficit and fiscal deficit, as well as the strong euro, the global monetary supply has increased. The United States has continuously lowered interest rates since September 11, and the federal funds benchmark interest rate has dropped from 3.5% in September 2001 to in June 2003. It reached 1% and remained at a historical low of 1% for nearly a year, triggering credit expansion in the United States and globally. With the expansion of the U.S. double deficit and capital markets, the U.S. dollar has become one of the main sources of global liquidity inflation. However, after June 2004, the Federal Reserve raised interest rates 17 times in a row, with the benchmark interest rate rapidly rising from 1% to 5.25%. Triggering the U.S. real estate crisis. After the outbreak of the crisis, the Federal Reserve has lowered interest rates 5 times in a row, from 5.25% in September 2007 to the current level from 5.25% in September 2007 to the current 3%, a decrease of up to 225 basis points. But it is still insufficient to alleviate the level of panic and market liquidity in the United States. Although the United States will further take interest rate cuts to save the crisis, With the rise of global price indices, interest rate hikes by countries such as China and Australia, and the readiness of Japan and Europe to take action against inflation, the Federal Reserve's interest rate reduction space will be constrained, and the overall monetary and credit situation of the United States is not optimistic. Thirdly, in the process of leading global economic growth in emerging markets, the relationship between commercial and financial institutions' credit expansion and rapid expansion of currency creation capacity. In 2007, China's deposit interest rates increased 6 times. It is puzzling that every time interest rate hike occurs, the stock index skyrockets. It is completely opposite to the theory of economic textbooks and the expected effect. Chinese enterprises are not very sensitive to interest rates. Once interest rates are raised, it will cause a decrease in loans for large state-owned enterprises, but private enterprises will quickly supplement them. In addition, the entry of residents' savings account into the stock market is also a rare combination after 20 or 30 years of wealth accumulation, which will not change due to minor interest rate adjustments. The only impact on China's interest rate is foreign arbitrage funds. Every interest rate increase is accompanied by billions or even tens of billions of dollars pouring in, and the central bank is forced to invest a large amount of RMB, which finally aggravates the foam. So without reducing the total amount of credit and consumption, the structure of consumption has been advanced, increasing the cost of funds for enterprises. On the contrary, raising interest rates has become the reason rather than an effective means to promote inflation and asset foam. In the process of global monetary liquidity contraction and expansion, it is not only central banks that play a role. The basic currency is not just the traditional credit expansion based on currency multipliers. Since the 1980s, various financial innovations have emerged in the international market. The combination of commercial capital and financial capital has made credit expansion between financial institutions and commercial institutions easier under certain conditions. The creation process and creativity are far beyond the range of base currency plus currency multiplier defined by traditional monetary banking. The amplification of all commercial credit providers and financial derivatives, together with the traditional central bank-based currency supply and commercial bank currency multiplier, have become the source of monetary liquidity. According to the data released by the Federal Reserve, the growth of money supply has not been very high since 2001. With an average annual growth of 3.2% for M1, 6.1% for square meter, and 7.39% for cubic meter. More liquidity in the market comes from credit creation between commercial and financial institutions. But the creation of this kind of credit, it is a double-edged sword, which has led to the rapid expansion of global monetary liquidity in the past 5 years. However, after credit destruction, it will also cause the rapid contraction of global monetary liquidity.